If you don't know me, my name is Moran, Pober, founder and CEO of acquisitions.com. At this point, we're the largest community of M&A investors, entrepreneurs, and roll-up investors and entrepreneurs. We're involved in 100 plus transactions in the last 3 years. Now we're also looking to invest and partner with our clients. Today, I'm going to share with you a presentation that I created when it comes to doing a roll-up. It's a presentation that I shared with potential partners of ours. Basically, they came to us from one of our programs. They introduced us to dozens of potential deals that want to join on a roll-up, and we are basically taking a lead on that, and they are joining as a scout. So there's basically, for those of you who don't know about what we're doing, we have basically, call it 3 gears of being in our community. So the first gear is for people who just want to passively invest in deals. Those are usually accredited investors. They don't want to do work. They just want to go out there and pretty much just invest in deals. The other vehicle is for people who just want to be scouts, people who want to find deals, and then we pay them a commission for finding and bringing deals. So we have investors, we have scouts, and then we have CEOs, people who want to take an active role on doing deals on their own and basically be the major owner of the acquisition or a roll-up. Anyway, let me share with you my screen, guys, real quick. I think that'll be really, really helpful for you to just see what I'm thinking about lately, what is in my mind, and how it can potentially help each and every one of you to buy your first business or do your own roll-up. Let me show you what that looks like. Let me share my presentation. Just give me, please let me know, give me a thumbs up or a message in the chat if you can see the presentation. Cool, appreciate it, William. And I see Tony is saying, I have a specific question around getting the policies and SOPs fully documented. The risk is if all key employees quit, then you end up with nothing if not documented. Yes, 100%, Tony. That's part of your due diligence, or if you understand how to run a business in the first place or buy a business in the first place, that have good processes, that have good systems, that you understand what the org chart looks like when it comes to understanding their sales, marketing, operations, finance, legal, HR compliance, all those things in a business. You definitely want to have an understanding and a deep dive walkthrough into diligence when you're doing a deal to see, okay, here's what's up in the business, here's the opportunity, here's the gap, here's what I can bring, or here's my potential downside, and how obviously it's your responsibility to make sure that you're protecting your downside as much as possible. And in the end of the day, understanding that business in general is risky, right? So also keeping that in mind as well, knowing that every business is risky. So at some point, and I'm sharing with you kind of like different perspectives, because I see different challenges with people. Some people are just not doing any due diligence at all. That's bad. They don't know what kind of due diligence they need to do. They don't know what details they need to check when they do a deal. The other side of people is people are just afraid to do anything. They just rather learn forever or stay in their comfort zone forever instead of having courage and jump into the water. And sometimes, just doing something and doing a deal. And sometimes doing a deal and losing money is better than doing nothing. I have people who came to me after doing very bad deals. I'm talking to people who spend their life savings and family life savings on businesses that are distressed, that they had to redeploy and deploy more of their own capital just to keep the business alive, business that is losing money. I think it's really bad. And that's why they came to me after doing those bad deals. At the same time, that deal is what brought them to me. And I'm not saying that I'm anything special. I'm just saying that the fact that they did that deal was almost like the point of no return. It's like, okay, I failed, but there's no way I'm giving up, because the pain is so, it's almost like, as weird as it sounds, I feel like sometimes we need to run away from pain to really be successful. You'll never see someone who's like a kid. Let me give you a weird example, right? But if you see an ice cream truck, you'll see kids running to the ice cream truck, right? They'll be excited, they'll be happy to run to the ice cream truck. At the same time, who's going to be more motivated? Someone who's running towards an ice cream truck or someone who's running away from a burning building? So the person who came to me after doing a bad deal, he was running away from a burning building. And I'll work with those people every day because I know they have fire in their guts. They're willing to do whatever it takes. So sometimes, I don't know how we got to this, but I think it's very important to understand that there's two sides for motivations in life in general. And sometimes having something to run away from is as powerful as running towards something. Anyway, guys, with that being said, let's talk about roll-ups. So anyone here know what is a roll-up? If you didn't know, now you know. Simply put, roll-up is a strategy where you seek to identify a single company or set of companies within an industry, and you leverage the use of both debt and cash flow to acquire additional firms in an industry. So basically, a roll-up is the opportunity or the idea of going out there and trying to buy as many companies as possible in a sector, merge them together, and build the biggest company that you can. Why would we pursue a roll-up strategy? Well, larger companies have access to increased efficiencies and economies of scale. In addition, larger companies are much more attractive to potential acquirers during exit scenarios, and it's not uncommon to see multiple expansion of what a business could be worth as they continue to acquire smaller bolt-on acquisitions. So what advantages are there to rolling companies up? Well, by acquiring multiple companies in a particular industry, we may be able to take advantage of some of the following key profitability drivers. Things like increased purchasing power, right? So larger order size could mean increased negotiating power with suppliers. If you're a bigger business, it means shared overhead costs. So things like rent, utilities, office, supplies can be eliminated by consolidating locations. Reduced back office needs, right? Larger companies could expect to save on accounting, legal, and other back office costs. Streamline processes to drive efficiencies. Streamline processes like sales, AP, AR, onboarding, payroll, by utilizing software that may be too expensive for smaller companies. Larger geographic footprint. Larger companies may be able to cover more ground and take advantage of localized market dynamics. Does it make sense, guys? I just want to quickly go through the chat. Enforce the process during due diligence. Not sure which process you're referring to, Tony, but yeah, in due diligence, you can pretty much make your own rules. All right, guys. So what ingredients make for a good roll-up? So some key factors to consider. Fragmented industry, right? The best roll-ups are in fragmented industries where there are few to no key competitors with scale, or where most participants are small to medium-sized mom and pop businesses. And that's kind of like what is getting us excited the most right now in acquisitions.com, is the idea that there's so many businesses out there right now with business owners who are motivated to sell, business owners who are looking to sell. The next generation is going to be insane. Like the amount of capital that is going to change hands with all the baby boomers looking to retire is unlike anything I think the world has ever seen. And that opportunity allows us to focus on different sectors. And that's why we're doing what we're doing with acquisitions.com. I know I can help any entrepreneur who want to buy his first business, buy a great first business. And we can help existing business owners to grow their business by acquisitions. And we can be the full, call it the operations, almost like the operation system for them to create that roll-up, to grow, to help them with everything when it comes to finding deals, analyzing deals, raising capital, closing deals, operating the business, because nuances matters. Otherwise, I don't know if some of you here are business owners, but if you are a business owner, you know how difficult it is to start a business, to grow a business. If you tried to scale the business in the past, all of you probably at some point hit some kind of a break point where you didn't know how to scale things further. And usually it's a combination of just not having enough efficiencies with what you do, with who you do it with, and with how you do things, with your processes, your systems. And that's what we really try to create here, to have like a full ecosystem for people who want to grow by acquisitions, because the last thing you want is to buy 10 messy businesses. You got to have good fundamentals in place so you could scale things. Let me know if it makes sense, guys. Hopefully that those things create curiosity in you guys as well, because it's definitely for me. I know that in the past, I had dozens of businesses that were in a mess. And if you think running one business is a challenge, running 10 or 12 or 15 can be very challenging if you don't have those good processes in place and good systems to keep everyone aligned and accountable and incentivized to grow towards a larger vision that you have. Anyway, back to ingredients for a good roll-up. So motivated or aging seller population, like I said, sellers in industries that aren't sexy, they have less of a chance of passing the business on to their children or other heirs, representing an opportunity for motivated acquirers, right? No one wants, like, there's so many, we're looking at like plumbing companies, so many good companies that are super profitable, but in the end of the day, their kids don't really want to be involved in those businesses, right? Every young entrepreneur, what they want to do, they want to be the next Uber, the next Airbnb. Next one, recurring contractual revenues. So generally revenue that contractually guaranteed and recurring ideally. For example, software, a lot of SaaS companies out there are like that, would be seen as more valuable when compared with revenues that chunkier and not necessarily recurring. For example, some large contract manufacturers, construction, etc. So ideally, we want to find businesses that have that recurring revenue, that have clients that over time pay more, not less, that we have clients that are staying with us long term. Those are the best businesses. Obviously, it means that we'll potentially need to pay them more, but sometimes it's worth it if the business is just more robust. History of profits and growth. All else equal, it's much easier to get excited about companies that have quantifiable history of profits and growth with the ability to reinvest profits into growing the business. These types of businesses are also able to more easily be leveraged if a friendly banker can have more certainty about the cash generating ability of the companies. Right? When you want to buy a business, the best thing for you is to have a business that has such great history of profits and growth and revenues and recurring revenue that it will allow you to access more of other people's money, to allow you to do bigger and better deals. Low capital expenditures. Low capital expenditures means asset-light businesses like software are generally viewed as more valuable when compared to businesses where constant maintenance capital expenditures must be spent in order to maintain the economic viability of the business. For example, oil and gas exploration and production. Right, very important as well. High defensible margins, or what Warren Buffett call moats. A company's ability to maintain higher margins can signal clear pricing power as well as significant value in the eyes of customers. This could come in a form of mission-critical parts, price insensitivity for the customer, lack of sophisticated competitors, or brand value. For example, who here likes Apple products? Like, would you be willing to pay more for Apple product if they raise their prices? I know that I would. It's like I'm so sold on the brand that I don't care how much they'll charge me, I'll continue to buy their stuff. And that's a huge moat for a business. They just created such a, it's like, I at this point, it's so weird, but I don't see myself owning anything but Apple when it comes to computers and phones and headphones, and it's like everything. So that kind of company can charge more, can have better margins, more profits. That's why it's such a great company. And at any point, because their customers are so loyal, how easy would that be to add like an additional service for Apple for like $10 a year or $100 a year? And adding something like that could easily create so much more, increase in profits for a company like that. So ideally, we want to find businesses with great moats. I'm not saying that we can find Apple, right? Especially when we're looking for small businesses and old school and boring in quotes businesses, but we want to find businesses with some secret sauce, something that potentially can be unique. And that uniqueness can be even systems, processes, ways to keep everyone accountable that is better than their competitors. That in itself can be super valuable to the market. So how can deals be sourced? So sourcing and process. Once we determine an industry where we believe an opportunity exists, it's time to start finding an initial candidate or candidates for acquisition. At this point, we build our outreach funnel in order to optimize the number of quality leads that we can get. Deals can be sourced a variety of ways. Some examples are outreach to business brokers, working personal network, cold outreach to current business owners, landing page and CEOs, ads. There's a lot of those strategies that we have. Different strategies like social media, letters, cold calling, going to events and whatnot. After a potential target seller is identified and has expressed an interest in selling, the acquisition.com team can evaluate the opportunity in order to move to the next stage. Assuming we get all the way to a signed LOI, we will begin due diligence. Assuming everything in diligence checks out, we will close on the deal and begin to streamline operations as well as begin looking for the next deal. So that's kind of like what the funnel looks like, right? Pretty straightforward. There's an initial reach out. Usually there's going to be some kind of follow-up with the business owner. And then continuing of screening and introduction, in-person meeting. Nowadays can be a Zoom. But then LOIs, signing LOI and closing the deal and doing the transition with the business. The most time-intensive part is definitely the outreach, to identify targets, to make lists, to contact potential sellers. We have in our network, like I said, scouts that are very valuable during outreach. There are, just great opportunity for us to scale this opportunity of doing those different roll-ups. A small investment in data providers is very common, or different subscriptions to trade shows, industry publications can also yield dividends through a pre-populated contact list. That's kind of like sourcing. This is kind of like what a sample roll-up model actually looks like. This model shows a potential deal that the acquisition.com recently screened and still working on. The analysis assumed we acquired 7 companies within a certain industry simultaneously. This deal had all of the hallmarks of a good roll-up. The industry is operated in a highly fragmented industry. There were significant efficiencies we could implement from day one, including cost-saving initiatives and outsourcing repeatable tasks. We benefited from economies of scale post-close due to the greater size and scale of pro forma entity. We believed we would be more competitive in the bidding process for new work. That's kind of like what it looks like, just to give you an idea of the model if you'd like to see. For some of you, it might be too overwhelming. For some of you, it's not, but I thought it will be cool to have it here as well. And those are, that's kind of like sample return analysis of what it looks like, assuming that we could enter at 5x and acquire, let's say, 20% of our EBITDA per year at 4 or 5x. We assumed some base margin improvement due to efficiencies we could implement from day one. Finally, we assumed a modest leverage profile, so 3x gross debt on EBITDA at close. And based on the scalability of the acquisition in question, this is a deal we would find very interesting. And as you can see, the returns here could be really, really good for anyone that might want to be involved in anything like that. So we are currently in the market for new potential platform deals and are willing to look at a variety of industries provided it fits our criteria. We are willing to pay finder's fee if we are brought a transaction that we ultimately close. Example, finder's fee structure includes basically up to 3% of net revenue or up to 100,000 for every 1 million EBITDA at closing, and potential equity in deals that close. The criteria for those roll-ups are ideally higher recurring revenue, loyal and diversified customer base, fragmented market, non-cyclical, recession resistant, revenue 3 to 20 million. It's kind of like the sweet spot. EBITDA and or annual cash flow 500,000 to 3.5 million. Flexible here as well. And we want to see at least 3 years history of profitability. So that's what it looks like, guys. I thought it will be cool to share it with you. Hopefully it opened your eyes to what's possible and what that looks like, what a roll-up like this could look like. You can do 1 deal at a time, you can do 5 or 7 at a time. It all comes down to your resourcefulness, how hard you're willing to work, how many deals you have in your pipeline, and your skills of going through negotiations on those deals, and of course closing them with capital and knowing how to operate them. And that's why right when we started, I wanted to introduce you the fact that if you're part of our acquisitions.com, call it community, you can join us as a scout and just find deals for fees. You can be eventually an investor if you're an accredited investor and invest in deals passively, or you can become a leading CEO or someone who's leading your own acquisition or roll-ups. And to do that, you can join our acquisitions accelerator, where we will even refund our service fee, if and when you allow us to invest and partner with you on deals. So that's hopefully summarizing what we're up to, guys. So with that being said, I'm happy to answer questions in the next minutes.